This is Nightly Business Report with Tyler Matheson and Sue Herrera.
Flexing some muscle. That's what the U.S. economy seems to be doing in the second quarter after an anemic start to the year.
3% down for a house. Sound familiar? The nation's largest mortgage lender is bringing back low down payment loans, but are they as risky as they once were?
Brain surgery just sounded so dramatic and severe and intense, and my greatest hope that day was that I would die on the table.
But she didn't, and the unconventional surgery to implant a device in her brain, her very last hope, actually worked. The second part of our series, Modern Medicine. Tonight on Nightly Business Report for Thursday, May 26th. Good evening, everyone. I'm Sharon Epperson, in tonight for Sue Herrera.
And I'm Tyler Matheson. Welcome, everybody. Well, signs of strength to tell you about, from the factory floor to housing data to the labor market. New numbers out today show the world's largest economy is rebounding in the second quarter from that slow start to the year. And you can be sure that the Federal Reserve, which says data drives decision-making, is paying very close attention. Let's start with jobs. The number of Americans applying for unemployment benefits fell last week, more than expected. According to the Labor Department, jobless claims were down 10,000 to a seasonally adjusted 268,000. That is the second straight week of declines following a choppy spring.
To the factory, where orders for long-lasting manufactured goods actually surged in April, according to the Commerce Department. Strong demand for transportation equipment helped lift durable goods orders nearly 3.5%, and that was well above expectations. However, a key proxy for business investment continued to show signs of weakness.
And the housing market continues to power right along this spring. The number of homes that went under contract to be sold climbed to the highest level in more than a decade. The National Association of Realtors says pending home sales in April rose more than 5%. That easily exceeded expectations. But as we've been reporting, one of the issues plaguing the housing market is affordability. As home prices rise, many just can't afford to buy, let alone make a down payment. So Wells Fargo has decided now to launch a new low down payment mortgage program. But as Diana Olick reports, skeptics wonder just how many first-time home buyers the program will really help.
The new home loan from the nation's largest lender requires just 3% down payment for a conventional fixed-rate loan funded by Fannie Mae.
We're offering a simplified product that is less expensive and we think a far better way for someone to buy their first home.
The down payment can come from a gift, perhaps from parents or community down payment assistance programs. Borrowers do not have to complete a home buyer education course, but if they do, they can get their interest rate slightly reduced. Borrowers must have at least a 620 FICO credit score, and they do need mortgage insurance. Critics argue this is a return to a time when borrowers didn't have enough skin in the game. But Wells Fargo claims it is still low risk to the bank.
With this product, we're being very clear that they have to have the ability to repay the mortgage. We have to make sure that they have a history of repaying debt or at the very least responsible management of their finances.
But there are a couple of hitches with that. First, Fannie Mae loans are exempt from the so-called ability to repay rules that federal regulators put in place after the credit crisis. Borrowers can have much higher debt levels compared to their incomes through Fannie Mae. Second, a 620 FICO score means you don't have a good history of repaying debt or managing finances, which means very few borrowers would qualify at that score unless they brought something else to the table.
You'd need something like either a big down payment, which you're not having with this loan, or a big bank account, which is unlikely with somebody who's lower income and may have a lower credit score.
Sakala says he does not think this will be a game changer for first-time borrowers, but it could bring big banks back into an area they've mostly abandoned since the financial crisis.
The reason Wells Fargo is doing this is not just its public conscience, but the fact that regulators are looking at them and saying, what are you doing to serve lower-income minority borrowers in areas where you collect deposit?
This new loan is Wells Fargo's answer, as long as the borrowers who ask for it qualify. For Nightly Business Report, I'm Diana Olick in Washington.
Stocks took a breather today after 2 days of triple-digit gains. Here are the numbers for the session. The Dow Jones Industrials declined 23 points. 17,828 was the close there. NASDAQ, however, added about 7 points to 4901. The S&P 500, it was down, but just by 0.02%. Despite today's small moves, stocks are working their way back toward their 2016 highs. But this market isn't the same as the one just a few weeks ago. Mike Santoli explains.
On the surface, not much is different. The corporate profit outlook for this year is about the same. The yield on the 10-year Treasury was below 2% then, and it's hardly budged. But oil prices have continued climbing, up more than 10% in the past 5 weeks to reach $50 a barrel. This has helped the market for riskier bonds to strengthen further, which offers better support for stocks. And shares of big banks, often viewed as a bellwether, are up nicely since the broad S&P 500 index was last at the 2100 mark. These factors suggest the market is on slightly firmer ground than it was in April. Perhaps the biggest change has come in investors' perception of the U.S. economy and the Federal Reserve's plans for raising interest rates. Consumer and industrial data have been good enough to support the case for a second quarter pickup in growth. And Federal Reserve officials have consistently suggested in recent weeks that another boost to short-term rates could come in June or July if the economic data keep improving. The Wall Street consensus had discounted this possibility, in part due to the impending vote on Britain's EU membership and the unsettled presidential campaign. While the bond market hasn't fully priced in the prospect of a rate hike within 2 months, it has moved in that direction. So, is it a good sign that stocks have been able to recover while odds of a rate hike have climbed, indicating investor comfort with the possibility? Or would markets react badly to another close call on rates, the way they did last September when the Fed stood pat and after the December rate boost? These are the questions that will likely animate summertime trading in a resilient market that now faces an obstacle course of high-stakes events. For Nightly Business Report, I'm Mike Santoli.
Oil prices broke a key milestone today. Domestic crude hit $50 a barrel before pulling back a bit, and that's its highest level since October of last year. Since oil's lows in February, oil prices have climbed 80%, an incredible ascent, helped by supply outages overseas, as well as recent reports that show a decrease in stockpiles.
Now, the question becomes, can oil continue to rise? Our next guest last year predicted oil would dip into the high teens. And for a while there, he looked like he'd be right. But then crude moved against him. Here to discuss what he sees now is our friend John Kilduff, founding partner. I would say I called you a founding father of Again Capital, but you are a founding father, so to speak.
Absolutely.
When you said high teens last year, I thought Kilduff is crazy. Then as oil went down into $26, $27, I thought, you're not so crazy, crazy like a fox. So what happened that caused oil to rebound and spring up the way it is? And are we near an intermediate term peak?
Well, yeah, and thanks for having me back. And
thanks for reminding me of.
And this is the last bastion of accountability.
Yes,
okay, right here,
that's
Nightly
right.
Business Report. I do believe that we're nearing a peak. I mean, a lot of influences have come together here to produce this $50 price print. Exogenous things like this massive Canadian wildfire knocked 1 million barrels off the market.
U.S. production is down.
U.S. production is down a lot. Actually, that is the one key fundamental that I can't argue with. And if I underestimated anything, it was how rapid the shale guys would shut down. And they shut down incredibly quickly. I mean, they have just abandoned plays. There are counties that were flourishing with oil production activity that are at zero. Yeah. And we are down 800,000 barrels.
Nigeria, Libya.
Those are issues that have always been on the table. So are they even more of concern now? Is that why we're seeing oil prices rise in terms of some of the geopolitical fears?
Well, the U.S. barrels that we lost were the cushion, let's call it that. So now Nigeria barrels they went begging for a home to sail to for many months of the year over the past year. The Libyan situation, though, it looks like it's coming back. There has been a deal there for a government. There are ships loading oil as we speak. Their production is rebounding. But I think what we're going to get reminded of here are two things. A, the OPEC meeting next week, I think will show that the cartel is very much in disarray still, that the Saudis, the Iranians, the Iraqis are all in the process of ramping up oil production, not lowering it, more than offsetting the U.S. loss.
Very quickly, where does oil end the year in your view?
I still think there's a possibility for a significant washout, but I think the production cuts have put a floor under things. $35 to $40, I think, is what
John
we
Kilduff, thanks very much.
Thank you.
Have a great long weekend.
You too.
President Obama and leaders of the group of 7 leading industrialized nations met today in Japan. The big topic was how to accelerate the global economy. But as Akiko Fujita reports, not all were in agreement on how to respond.
The health of the global economy dominated talks on this first day of the G7 summit, but leaders were in disagreement over where they believe the recovery stands. Germany's Angela Merkel coming out and saying she believes the global economy is showing a certain amount of stable growth, while Prime Minister Shinzo Abe here in Japan warning of a Lehman-like event, specifically citing the growth rate in emerging markets and commodity prices, saying they are at levels not seen since the financial crisis in 2008. The TPP also on the agenda here with the trade deal yet to be ratified. Leaders agreeing to speed up the process, aiming to have the deal finalized by the fall and take effect as early as next year. As for geopolitical risk, China and the territorial disputes in the South China Sea dominating discussions, but President Obama saying G7 leaders also expressed concerns about the U.S. presidential election.
They're rattled by it, and for good reason, because a lot of the proposals that he's made display either ignorance of world affairs or a cavalier attitude or an interest in getting tweets and headlines instead of actually thinking through what it is that is required to keep America safe.
Tomorrow, the attention shifts to Hiroshima, where President Obama will become the first sitting U.S. president to visit the site of the nuclear attack. He has made it clear there will be no apology, but the president said today that this visit would be a reminder that the job still isn't done when it comes to reducing conflict and the prospect of nuclear war in the future. For Nightly Business Report, Akiko Fujita, Iseshima, Japan.
Still ahead, could rising wages for fast food workers backfire on the very people they're meant to help?
A legal victory for Google. A jury sided with Google's parent Alphabet in its long-running copyright lawsuit against Oracle. The other day, we told you that the outcome of the trial could ripple through the entire software industry. Deirdre Boza has the details from the courthouse now in San Francisco.
After 6 years of litigation and plenty of increasingly heated back and forth between two tech titans, the jury in the courthouse behind me has decided in favor of Google. Essentially, they have decided that the company did not violate Oracle's copyright when it used Java programming to create Android. We have since heard from both companies giving statements. Let me read you the first from Oracle. They said that they brought this lawsuit to put a stop to Google's illegal behavior. We believe there are numerous grounds for appeal. Google, for their part, issued this statement. Today's verdict that Android makes fair use of Java APIs represents a win for the Android ecosystem, for the Java programming community, and for software developers who rely on open and free programming languages. So Google will not have to pay $9 billion, and there is likely a sigh of relief among the huge community of developers and startups that rely on open source. That is the software at the heart of this nearly 6-year lawsuit. As for what's next, well, likely a lengthy appeals process, as Oracle alluded to. But for now, a victory for Google, whose lawyers, shortly after their decision was handed down, said they were going out to celebrate. Deirdre Boza for Nightly Business Report in San Francisco.
McDonald's temporarily shut its headquarters outside Chicago because of demonstrators. The protesters were marching for $15 an hour minimum wage and rights to form a union on the same day the company was hosting its annual shareholders meeting. This is the third year in a row the burger chain has had to ask headquarter workers to stay home for the day.
And as fast food workers around the country do push for that $15 an hour minimum wage, McDonald's USA former CEO Ed Renzi says it's cheaper to invest in new technology and automation rather than increase workers' wages. Others in the restaurant industry agree with him.
People are going to look to automate everything they can, especially in the kitchen, where you can build equipment to do certain things for you. If the government and the states continue to push this $15 wage and not give tip credit for the waiters, you are going to see a huge layoff in people. When you look at the payout over a number of years, you cannot pay somebody $15 an hour when somebody's buying a burger for $4. It does not work.
And joining us now to discuss this is Erik Brynjolfsson. He's a professor of management at MIT's Sloan School, director of MIT's initiative on the digital economy. Professor, welcome. Good to have you with us. Automation is coming, whether there's a hike in the minimum wage or not. How disruptive, transformative, maybe, is it going to be in the restaurant business?
I think it's going to be very big, and we've already seen that technology is having some big effects in terms of median wages. They've stagnated for a while, and the technologies that are in the pipeline will be able to automate a lot more tasks in the next 10 years than they did in the last 10.
One of the things that you've pointed out in your research is the divergence that we've seen over the years in terms of productivity growth and employment growth. And we're looking at jobs today from taking tolls at the highway to restaurant workers to people even taking your blood pressure. All of those jobs have gone away and now have been placed by machines. How has this divergence between productivity and employment really played into what we're seeing?
Well, that's exactly right. Historically, as productivity grew and the pie got bigger, there was a rising tide that lifted everybody. Wages rose for everybody. But for the past 20 years or so, median income has stagnated, even fallen. There's been a falling share of the people who are working. And there are many reasons for that, but part of it is that technology is automating a lot of routine, repetitive kinds of jobs. There's still more demand for data scientists, for creative people, for caring and nurturing, but people who do routine work are finding it harder and harder to compete with machines.
Let's go back to the restaurant business. I presume that as automation comes in, whether it's taking orders, bagging French fries at McDonald's or Wendy's or wherever, that is going to mean fewer jobs in those locations. Is that race towards fewer jobs going to be accelerated by a rise in the median wage? In other words, are companies going to accelerate the use of automation costing jobs as wages rise?
There will be some of that. And to keep this in perspective, we should understand that technology has always been destroying jobs. It's always been creating jobs. And there's a balance, there's a churn there that's natural and healthy. In fact, that's how the economy becomes more productive, and that's how our living standards rise as people move from one area to another. But it is true that if you push up the wages, say through a minimum wage, that does increase the incentive for companies to automate faster than they otherwise would have.
All right, Professor, thank you very much. I'm sure this will be an ongoing conversation. We hope to have you back soon. Erik Brynjolfsson with MIT.
Total sales slide for the 13th straight quarter at Abercrombie & Fitch, and that's where we begin tonight's Market Focus. The fashion retailer also reported a decline in profit as fewer shoppers hit the stores. The results fell short of expectations. Abercrombie also says the current quarter will remain challenging. Shares plummeted more than 15% to $21.14. Sears says it will explore options for its iconic Kenmore, Craftsman, and Die Hard brands by expanding their availability outside of its stores. The news comes as the retailer posted a continued decline in quarterly earnings and revenue. The company also announced the departure of its chief financial officer. Investors seem to be pleased with the news. Shares rose 6.5% to $13.34. And sales soared at discount chain Dollar Tree, prompting the company to raise its guidance for the year. Profit also rose and topped estimates, driven in part by the company's addition of nearly 8,000 stores from its acquisition of rival Family Dollar. Shares were up more than 12.5% to $88.37.
Profit rose a whopping 46% at Burlington stores, which helped the off-price retailer top estimates today. Sales were also higher and above estimates. The strong quarter prompted the company to raise its full-year outlook. Shares finished today up nearly 7.5% to An increase in new members and membership fees drove profit higher at Costco. Despite the positive news, comparable store sales remained flat for the quarter, well below the 2% gain analysts were expecting. Nonetheless, shares rose 3.5%. 149.71 was the close there. And U.S. Foods made a splash today in its first day as a public company. The food services outfit raised more than $1 billion in one of the biggest initial public offerings so far this year. Shares up better than 8% to $24.91. And a top Apple executive reportedly raised the idea of buying Time Warner at a meeting between the two companies, but the idea never got off the ground. The Financial Times says Apple would likely be more inclined to buy a video streaming company. Do any names come to mind? How about Netflix, as it looks to increase its spending on original content? Apple, Time Warner, Netflix, all up on the day.
You know, Mad Men may have left the air a year ago, but fans of the retro show can now bring a piece of it home, part of a rising trend of auctioning Hollywood memorabilia. And that's creating a new source of revenue for studios. Julia Borston has the story from Los Angeles.
Want Peggy Olson's typewriter or Don Draper's lighter? There are over 1,500 Mad Men props and set pieces up for sale, sold on behalf of Lionsgate from Mad Men's 92 episodes over 7 seasons. ScreenBid, an auction house that specializes in items from TV shows, will start the auction on Wednesday, many of the items starting at less than $100. Fans can bid online, and auction winners receive a certificate of authenticity and a screenshot of where the product was within the show. ScreenBid charges a buyer's fee and takes a cut, delivering the rest to Lionsgate.
Here is a brand new monetization, for you. And beyond just the, incremental dollars and cents that are going to fall to your bottom line, it is a wonderful marketing engagement and a cultural extension.
Lionsgate and other studios benefit not just from incremental revenue from selling items like Don Draper's glasses or his lighter, but also the fact that auctions like these help drum up attention for shows long after they've left the air, inspiring fans to download episodes on iTunes or Amazon or to stream them on Netflix, helping media giants extend the life of their brands. And the fact that it's now easy for people to binge on shows long after they leave the air grows the potential fan base for these kinds of auctions.
The availability of the streaming services for people to access the show whenever they want and to revisit these characters, revisit these storylines is going to make the demand really high.
There are no official estimates, but the business of selling Hollywood memorabilia generates at least $1 billion in annual sales, according to ScreenBid's chairman. A sale of Breaking Bad props brought in more than $65,000 for Walter White's copy of Leaves of Grass alone. So some of these items could get up into the tens or even hundreds of thousands of dollars for something like Don Draper's car. For Nightly Business Report, I'm Julia Borston in Los Angeles.
Coming up, why researchers may have a whole new set of options when it comes to treating depression, substance abuse, even PTSD. The second part of our Modern Medicine series is next. The human brain, a miracle, of course, and in many ways still a medical mystery. But now technology is helping doctors understand how the brain really works, and in the process is unlocking new treatments. Meg Terrell has the second part of our series, Modern Medicine.
As many as 1 in 5 veterans return from war with post-traumatic stress disorder. Their current options for treatment, behavioral therapy, and medicines. But those options don't address the electrical circuitry governing our bodies and brains.
We focused a lot on the chemical side because in the mid-20th century we began to develop the first medications that affected neurotransmitters.
Dr. Darren Doherty is director of the Division of Neurotherapeutics and the Department of Psychiatry at Massachusetts General Hospital.
The other side is the electrical, and that's been less exploited as a treatment potential.
Doherty and others are working to change that. With funding from the Defense Advanced Research Projects Agency, or DARPA, scientists are working to build new ways to treat psychiatric disorders like PTSD, through deeper understandings of the electrical signals in our brains.
What it really boils down to is precision interaction with the neurons of the brain that are involved in neuropsychiatric illness.
Already, patients are using early models. Deep brain stimulation is FDA approved for the treatment of Parkinson's disease symptoms, as well as obsessive compulsive disorder. Liz Murphy had a deep brain stimulation device implanted 10 years ago to treat her severe depression. She calls it a lifesaver.
This episode started in August 2004, and nothing could budge it. I have a resume of like 7 pages with all the drugs I tried. I did 30 rounds of ECT, nothing made a dent, and just getting worse and worse and worse.
Out of options, Murphy agreed to try deep brain stimulation, not FDA approved for depression. It's a serious procedure requiring brain surgery to put in place.
Brain surgery just sounded so dramatic and severe and intense, and my greatest hope that day was that I would die on the table. I just had no, it was going to be my last shot, you know. I'll do this, and if it doesn't work, I can say I tried everything, but it worked.
The device Murphy has sends a constant electrical charge to her brain. The newer prototypes being developed will be a closed-loop system, sensing misfires among neurons and sending corrective charges when needed.
When it reached a certain threshold, it would stimulate another brain area that, when it activates, would suppress those neurons and the symptoms associated with it.
Researchers hope it will present a whole new set of options for treating everything from depression to substance addiction to PTSD. For Nightly Business Report, I'm Meg Terrell.
To read more about deep brain stimulation and its promise, head to our website, nbr.com. And tomorrow, Meg tells us the story of 2 siblings who, because of new medical advances, can see again. Fascinating stuff with the brain.
Fascinating report. And mental health, such an area that many people don't want to delve into and find out how to treat, even the conventional ways. And these ways are fantastic.
Truly so.
All right. That's Nightly Business Report for tonight. I'm Sharon Epperson. Thanks so much for watching.
I'm Tyler Mathisen. Thanks from me as well. Have a great evening, everybody. We'll hope to see you right back here tomorrow night.